Keynes himself was the leader of the British delegation to the Bretton Woods system. So the other delegates were influenced by this idea that central banks ought to have more leeway. But there was a third objective, and the third objective was to restore free trade and international capital mobility. Right? Not have exchange controls, not have import quotas. These three things together are incompatible, because if you have a fixed exchange rate, let's say between the Bahamian dollar and the US dollar, where goods and payments are allowed to flow freely, that implies that the price level in the Bahamas has to be constrained by the price level in the United States. It may not seem that way, and it doesn't seem that way to me shopping here in Atlantis. But I mean, there is a constraint that the prices of traded goods in the Bahamas can't be too far different from U.S. prices, and the too far is determined by transportation costs, but probably the bigger thing is taxes. Right? So taxes will drive a wedge, but it's not an unlimited wedge. So money will flow out of a high-priced area and flow into a low-priced area, which means that if you have a serious commitment to the fixed exchange rate, then the quantity of money in the economy becomes market-determined, or endogenous, to use the technical term. So one of these three goals has to give. Either you let the money supply adjust through the market, in which case you've given up independent national monetary policy, or if you try to stop it, you have to impose exchange controls, you've given up free flow. Or alternatively, if you float, you've given up the first goal, which is fixed exchange rates. But one of them has to go. All right, so as a polity, you can make your choice, but you can't have all three. You can't eat your cake and have it too. The label that economists now give to this trio of goals, which are mutually incompatible, you can only have two out of the three, not all three, is to call them the impossible trinity. So I'm not sure, maybe you can tell me how serious the Central Bank of the Bahamas is about having goals other than keeping the exchange rate fixed. But by announcing other goals, if they're not even using that option, they're giving up credibility in return for nothing. And that's even more puzzling. So which is it? Are they actually pursuing other goals, in which case they're endangering the fixity of the exchange rate? Or are they not? Are they implicitly acting just like a currency board? But if they are, why don't they grasp the benefits of having a pre-commitment by becoming an outright currency board? If that's what they really think is best, then they should go to Parliament and say, please, convert us back into a currency board. There's no point in pretending to have goals contrary to safeguarding the exchange rate if you really want to safeguard the exchange rate. If you make the fix less credible than that, you're just going to have more volatile capital flows, right? People moving their money out because they're worried about devaluation. And that makes it more difficult to maintain the peg, so you're making life more difficult for yourself. So you could say that with a weak peg, the risk of devaluation is hanging like a sword over contracts in Bahamian dollars. It's hard to say, as I said before, how much impact it has on foreign direct investment, because you can't observe what isn't invested, but it can't be good for it. I understand that a lot of tourist businesses, well, I discovered this myself actually shopping around on the web, give you a discount if you buy online before you leave the U.S. And that way the money goes to their U.S. subsidiary, never comes to the Bahamas. They don't have to worry about being able to send it back to the U.S. Right? So there's one indicator. But probably a more important indicator of the risk of devaluation is that when the same borrower borrows money in Bahamas dollars, that borrower pays a higher interest rate than when he borrows in U.S. dollars. And who is that borrower? The Bahamian government. Right? It has both debt denominated in Bahamas dollars and external debt denominated in U.S. dollars. It pays a higher interest rate. It's not default risk, same default risk on both loans. It's devaluation risk. Right? In Argentina, which I mentioned earlier, it was legal to have US dollar bank accounts, and you could walk down the street and measure the devaluation risk because the same bank would have a sign in the window. Account in US dollars, we're paying 3%. Account in Argentine pesos, pegged 1-to-1 with the US dollar, we're paying 4%. That means they couldn't attract people at 3% because of the devaluation risk. Right? We can't observe that here because there are no signs saying open an account in US dollars and we'll pay you this. But when you see restrictions put on the ability of the citizens to redeem for US dollars and then move the dollars out of the country, that's suggesting that there's a fairly weak peg. It's being propped up with exchange controls. Whereas if you have a stronger commitment, here's another bit of jargon, this is starting to become known among economists as a super fixed exchange rate, right, to distinguish it from a weakly fixed exchange rate. If you have a super fixed exchange rate, you don't need exchange controls. So super fixing would mean a currency board, an orthodox currency board, or an outright US dollar standard. To try to occupy the middle ground between floating and super fixing is to fall between two stools. Right? You don't get the benefits of either. So the historical record of currency boards is good, not only in the colonial period, but among the modern countries that have them today. They've gotten better performance than when they had central banks. I was surprised to learn when I was talking to Wendell Jones this afternoon that the Bahamas is a third world country. But that was his position. Well, Kurt Schuler, who I mentioned earlier, has a book entitled "Should Developing Countries Have Central Bankers?" Have central banks. This is available from the Institute of Economic Affairs in London. And he compiles lots and lots of data on every country that's had a central bank or a currency board and how did it do in each period. And overwhelmingly, experience was better under currency boards than under central banks. Now, an objection to outright dollarization, and one of the arguments people make for having a currency board rather than outright dollarization, that is, letting people use US dollars as much as they want, is that, well, if we import US dollars, then we're losing seigniorage. We're losing the profit from issuing currency. We have a currency board, as I mentioned, they make a profit. They earn more interest. They don't pay any interest they earn interest on their assets. They don't pay interest on their currency. Well, there's a very easy way to avoid that. That is, you can have a US dollar standard without having a currency board. Not have a currency board. You can have a US dollar standard without using Federal Reserve notes, without therefore giving your seigniorage to Uncle Sam. How do you do that? Let private commercial banks in the Bahamas issue their own currency notes. And as I said before, we have living examples of that kind of system in Hong Kong, Scotland, Northern Ireland. So Scotland is a sterlingized economy, but the common currency in circulation are the notes of the Royal Bank of Scotland, the Bank of Scotland, and the Clydesdale Bank. In Northern Ireland, where I used to teach every year for a week, there are 4 different banks that issue currency notes. They all circulate 1-to-1 with each other at par. You might get any one of them in change. Now, if you go to the ATM of the Northern Bank, you only get Northern Bank notes. That's how they get them into circulation. And to encourage you to go to their ATM, they don't charge any fees for using ATMs, so there's a tangible benefit to the public from this kind of system. And these notes are more popular than Bank of England notes, which also circulate, but not as much, even though the private banknotes are not legal tender. Right? People use them voluntarily. They are a legal medium of exchange, but they're not legal tender in the sense that nobody is compelled to take them. If somebody doesn't want to take them, they don't have to take them. But everybody does. So it's better. I think competitive private issue of banknotes is better than government monopoly for pretty much the same reason that competition is better than statutory monopoly in any business. It's better for consumers. When firms have to compete for the profits, in this case the profits from